I want to talk to you about some important concepts as an introduction, okay? About the bank's role in a lasting financial stability, which is not a simple task, especially at the time of pandemics, financial crisis, and many new risks, okay, emerging from many new financial instruments. So, money and economic growth on one side and the risk management on the other side, okay, it's a dilemma, right? A dilemma of probability of losing besides of the probability of gain. So the financial institutions can't live with it and they can't live without it, okay? So the people also like the life accompanied with a little bit hazards because human beings have something of an appetite of novelty, okay? And we love new banking with a lot of new technologies, don't you? Adam Smith 200 years ago spoke about our desire for a life without shame. So 200 years ago, what that meant was a very simple life and common food, and today, well, you still need food, but you need the online banking, the netbook and iPad, okay? We are talking about artificial intelligence, and even if we don't want them, we like to buy them, right? We like new ideas, new adventures, new experiences, full of technology, machine learning, buzzwords like artificial intelligence, and we also accept its risks, okay? Okay. And here, all of a sudden, we have a system that could lock economic structure with new potential risks, and who we are as financial data scientists, lock together to drive an engine of this growth, right? To make economic value and control the risks, okay? So, the authorities out there are also helping this movement. Central banks have expanded the money supply, the banks have expanded credit and debt, so that people can keep buying technological stuff and using the open banking, for example. And of course, that expansion was deeply implicated in the crisis and risks. So the risk management will get more and more important, and we need much more complicated systems to manage risks, okay? Now let me tell you about this question that I get a lot of, even from professional data scientists in finance and risk analysts that have been in the field for years. It might help you to understand how much you will be important in the business if you learn data science in finance, and why the accounting reports might not be sufficient for financial institutions without data analysis, okay? So I want to tackle this question really quickly right now. What will happen if the financing only finance instead of real sector of economy? Okay? So it's a very important question. By financing only finance, I mean the stock market, banking, insurance, and real estate. Well, GDP, financial stability, sustainable growth will be damaged dramatically, right? The financial crisis will be out there, okay? And GDP will be declining as a result. So, what is the role of data and analytics? Let me explain myself with an example. For many years, net interest payment didn't go into GDP because only those activities that had an explicit price were included, okay? This huge amount as the difference between what banks were earning in interest if they gave you a loan and what they were paying out for a deposit was ignored for a long time. So the data scientists started to look at some data. Okay? So they showed that the size of finance and these net interest payments were actually growing sustainably with and the SNA, okay, system of national accounts in the United Nations, gave it a name, financial intermediation, okay, and also the investment banks were called the risk-taking activities, okay. For example, if you take a look at the data from the 1970s and 80s, and many data scientists writing about it, okay, what actually happened was financing finance by finance, okay, and the share of real economy and industry was very low. But now we are aware of these risk-taking activities, and we can go further to analyze the data and manage the risk better. That was the data which show us this important part of finance with a huge potential risk, right? So we can now understand how much monetary the financial data could be important and how much data can help us to understand the risk and save more opportunities for economy. Well, up until now, we learned about the importance of risk and analyzing the data, and now we want to focus especially on banks. The first question is, what is a bank? Okay, so banks are enterprises which use others' money as input to fund their activities. They use deposit money, okay, other banks' money as money market lending operation. Central banks' money as a part of monetary policy of banking. Investors' money and they own a small fraction of asset as shareholders' money, okay? And their activities are mainly focused on allocate those funds for other sectors of economy to generate some returns. For example, lending operations, provide some services, and contributing in the money market as a main player, okay? So remember, the banks which could not capture funds, they cannot make money or a sort of income or profit, okay? So the second question is how banks capture funds to conduct their activity. Okay, so basically the banks, like other companies, have their own equity capital funded by their shareholders. It's a small part of balance sheet, of course, typically in Euro area minimum 10% of capital, okay, depending to the kind of the bank. But in the other parts of the world, it depends to the central banks, okay, and their recommendations on capital to asset ratio fraction or capital adequacy ratio and so on and so forth. Okay, so banks have other external sources of funding, of course, for financing their activities, such as normal deposits, okay, the checking deposits, current side, and debt from central banks, also issuing debt instruments in capital markets, and finally short-term lending from other banks as a money market lending operation based on Euribor, okay, which is an interest rate that the banks are willing to lend the money to each other in the money market, okay. So an important point here about Euribor is it is not an interest rate that the central bank offers to the banks, but it is calculated by European Money Markets Institute, EMMI, as a truncated average of offered rates by some well-known banks with good reputations, okay? So based on that, the banks can decide how to financing themselves for short term by other banks. So remember, for the banks, all of these resources of money are liabilities, not assets. Okay, so the next good question is how banks use their resources. The main asset allocation for the banks, which are in asset side of banks' balance sheet, are lending to individuals, companies, or other banks as the money market lending operation and receive interest. Okay. The second one is financing economy. The third one is invest in financial markets, share stocks by their own funds without exposing any risk for their customers. The only cost for the customers would be charge of fees and commissions. In the balance sheet of the banks, this comprises, as we called it, trading book of the bank, okay, including financial securities. Banks also have other portfolios as capital market portfolios or bonds and other debt instruments, and they hold them until the maturity, okay? So they don't trade them actively, just look for coupons payments, okay? And the last one is investing in real assets, such as real estate as an investment or similar to normal companies. Banks also buy buildings for the branches, for example, for the data centers, logistics, and so on and so forth. Okay? So the sources of revenues for the banks. The sources of revenues for the banks would be charge of fees and commissions for services, interest income from borrowing operations, and lending and receive benefits from margins. Okay, I mean the difference between the interest of lending and deposits. And the last but not the least, income from investing in financial markets by coupons or selling the securities in the higher price of instruments than they were being bought before. Okay, so the banks can increase income by providing more lending and increasing lending operations in volume, okay, amount of loans, price, which is interest rate, or the composition of the lending to increase the amount of high interest rate loans. They also can increase the fees of services or commissions, okay? So it seems very simple, but actually it is not. There are always risks out there, mainly credit risk, market risk, and operational risk, okay? So in the next sessions, we will talk completely about credit risk and credit scoring by our software. But by now, let's say operational risk in general stands for any failure in processes or any elements involved in operations. Failure might be fraud, failure in the system, and IT infrastructure, okay? So whatever in the banking operation and for the market risk for lending, if the interest rate of loan is fixed and interest rate increased by time, then there is an opportunity cost, right, for the bank because of losing the benefit of margins, okay? They depends on money market operations and the yield curve, okay? So managing the risk would be much more significant when we add derivative contracts like forward contracts or future contracts or OTC, over the counter, which not only need data and knowledge, okay, but also experience and maybe a little bit chance, okay? In OTC, the securities are traded for companies that are not listed on a formal exchange market by a broker-dealer network, okay? And it is completely different with centralized exchange with many requirements of a standard market exchange. So a financial crisis could be possible by them if the things do not work, such as the market image. Okay. Okay, when we are analyzing the bank's risks, we have to know how to read and understand the balance sheets, okay, and other financial statements, of course. We should know how to analyze passive operations and decompose liability side, and how to analyze the active operations and decompose the asset side, okay? We have to know about the neutral operations and off-balance sheet items, the regulations, regulatory requirements, and the bank's strategies and internal systems, of course. Okay, so the first thing I'm going to do is I'm going to demonstrate what a balance sheet and an income statement of a bank would normally look, and then get our hand dirty with some calculations, okay, some interesting financial ratios to help us understand the bank's situation, okay. This is what I really like it. In my point of view, the banking activities, frameworks, and standards are really amazing. But okay, if I'm a bias, give me a break, okay? So, for more people, bank is a black box, okay? And it is understandable. Always you can find something new in the banking concepts and regulations, okay? But don't worry, we are going to make it as easy as possible and this would be an enjoyable start, okay? If you'd like to read more about these regulations, here there is a complete list related to the course, but it is completely optional, okay?